enable. Reliance Mutual Fund and CNBC TV 18 present Mutual Fund Day, Mission Prosperity.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Millennials today have seemingly embraced the YOLO philosophy, where living the good life right now may be far more important than planning for the future. However, planning for finances is an indispensable activity for all of us. This financial planning becomes even more critical for someone who has just started earning. Hence, it becomes important for them to devise a financial strategy right from the beginning in order to make the best of their earnings life while not compromising on their lifestyle and getting, of course, all that they desire. All it takes to get on the right path to financial security is the willingness to create wealth and, of course, a little investment in financial knowledge as well. Hello and welcome to Reliance Mutual Fund Presents Life Hacks. Today on our show, we will be discussing the importance of financial planning for first-time working professionals. On our show, we have with us Mr. Shailesh Raj Bhan, Deputy CIO at Reliance Mutual Fund, and Mr. Harsh Rungta, who is an independent financial advisor and a financial planning expert. Gentlemen, it's great to have you with us in the studios today, and we are discussing what's, of course, a very interesting and important theme. I want to get some opening thoughts from the two of you, whether you have come across, either clients or people around in family, friends, where you see and interact with young working professional, and what sort of attributes do you pick up with respect to money or investment? So, Shailesh, let's get your opening impressions first.
The first thing, people think that they have too much time on their side when they start off. The younger generation has that feeling that we are too young to do or think anything about financial planning and investment. I think that is one fundamental point which comes across. The second is there are a lot of needs which come ahead. It's more consumption which may not have any advantage over long periods of time. That is a very important area where actually people go and spend money. For example, a lot of people see savings as after what you spend is left is called savings. I think if they're able to invert it and say that first you save and then spend what is left would well be the approach which we would find very important and very helpful for them.
Okay. Well, that's a tough prescription right at the start of the show. But yes, we will take it step by step and make it a little more easier to perhaps digest as well. So, Mr. Rungta, in your years of advising people on how to create money, generate wealth, what is it that you pick up when you talk to young people, in their 20s?
My experience is that it's a very conscious generation. It reads, it's exposed. It not only talks savings, it talks investments, it talks all. I think this generation is special. Okay, and I just hope that it infects. So maybe I'm meeting only a part of the generation, but I suspect, given the reach that media has, programs such as this spark that is there should become a big fire.
Well, absolutely. Good note to start on. Shailesh, let's now break this down and make it as simple as possible for our friends in the audience as well. I think when you're young, a couple of things happen. You've just started out, so as you're saying, money management is not really top of mind. It's more about enjoying the good life that you're beginning to earn. But what is the planning process? How can one start and begin? How do you start getting a little streamlined and systematic about your finances?
See, a lot of investment decisions are just about the time frame, when you need, what is your goal you're trying to achieve with. The minute you get to an understanding of what are the goals which are there, whether they are short-term, medium-term or long-term goals, based on that you can set up simple plans. You don't need any technical, complicated jargon to achieve this. Just that at what age you require how much of capital for what need. Once you have some clarity on that, right, and you always know what is the income today, right, and then you can manage your savings around it. So it's just about setting your goals right. Choosing the right goals obviously is an individual choice, but I think once you have the goal, I think just trying to map it as to what's my 1-year goal, 5-year goal, 10-year goal in terms of achieving it.
Okay, fair enough. So we're going to do the goal setting bit in just a moment. Mr. Rungta, another important thing, this ratio between how much can I spend and how much should I idly be saving, I think that's where a lot of sort of heartache is also involved. So is there a thumb rule that you have in mind?
Yeah, so I have what is called a 70-30 rule. That you pay out 30% of your salary to your future self. Okay. And I think the general prescription that people have of financial planners is that don't spend now, so keep everything for your retirement. Okay, that is so absolutely not true. The reason you invest that 30% is that afterwards, from that balance 70%, you can spend guiltlessly. Imagine the fun you have when you have invested enough. You know you have done the right thing. After that, when you spend the balance 70% on whatever it is that you think is correct, right?
So
I think you will enjoy the spend.
So, Shailesh, let's then get down to this goal-setting business. Short-term, medium-term, long-term. What can go in which basket, and how do you go about this?
Typically, any expense item which is not normal and people need within the next 12 to 24 months is primarily short-term requirement. Ideally, this should go in lower risk investments or risk-free investments, and you keep it aside. Some people may call it emergency expenses. Some people might call it defined needs which are clear. Generally, you have clarity for a 12-month window kind of thing of what you require. Beyond that, when you look at longer-term investing and longer-term time frames of saving, you have specific targeted needs. The beauty of being young is that you have very little expenses when you start off with. Right? Then in the life cycle, your expenses keep moving up after a point of time. So early stages, there easy availability of excess cash flow to save and start saving. So one is to just focus on the fact that time is on your side, and that is the single biggest asset you have. And having short-term and long-term, just classifying into two specific goal categories, one can approach it.
Okay. So let's come down to the type of funds that can fulfill these needs. If you're looking at the short-term, then should you be looking at equity as an asset class, or are you better off looking at debt? And within debt, it's a fairly complex world of mutual funds. There's some 16 categories. Liquid and the other types, bond funds, etc. So help us start off. Basic short-term goals.
See, if you have a very short-term requirement of capital, say with the less than 12-month window, 6 to 12-month kind of a window, it's very simple. You've got liquid funds which serve the need, and they invest in short-term instruments of government or various other companies, and they take care of, without much volatility, they take care of the short-term liquid requirements of anybody. If you have a horizon of more than, say, 3 year plus, that's the second horizon, which is longer-term horizon, clearly you can give time to your money, which is like you can start investing in equities or equity products. And within that also you may have categories like a balanced product, which is a combination of debt and equity that can be used. And for horizons more than 3 years plus, 5 years, 7 year horizons, you have pure diversified equity funds which are there to participate in.
Okay, so coming down to the first category in little more detail, what can we expect from liquid funds? What kind of instruments are these, and do they make sense for almost anybody? Are there any sort of risks involved? What should one be aware of?
See, liquid funds primarily are used for parking short-term requirement, short-term capital requirement, which anybody has. And compared to traditional alternatives, this is one equally good opportunity or alternative available. These funds cannot give you exceptional returns or large returns, but these funds give you what the money market rates are generally. And the most important advantage is they are as liquid as anybody else. You can withdraw money in very short notice and such stuff.
Sure.
So they provide you the flexibility of having the access to that capital which you want, or the money which you want at the point of time.
Okay. Mr. Rungta, a question on the second category, which is your medium-term goals. Whether 6, 7 years down the line, 5 years down the line, you want to start investing, or rather you want to start investing so you can, let's say, buy yourself a car after 5 years, medium term. Now, for this category, as Shailesh mentioned, maybe balance funds are a good way to go. I can explain some of the nuances to us, and what goes into these kind of funds.
So, balanced fund, as the nomenclature says it, it is a balance between equity and debt. So, it is counter-cyclical. By definition, it is counter-cyclical. It buys when the prices are lower, and it has to sell when the prices are higher.
Sure.
So, I think that gives a superb balance. I think balanced funds are an excellent way of investing. The returns after 12 months are tax-free.
Yeah, because they're treated like an equity fund, because they always, at any given point in time, invest 65% in equity. Okay, so now that we have some ideas about how to deal with the short-term goals and the medium-term goals, The question is long term. What are you really looking out for? Is there a house purchase you have in mind? You want to create a corpus perhaps for higher education? You want to go to the US 10 years down the line. So those long term goals can also be funded via correct investments at the present moment. We will talk about those sort of investments when we come back after the break.
Reliance Mutual Fund and CNBC TV 18 present Mutual Fund Day, Mission Prosperity.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Welcome back. You're watching the special Life Hacks, and here we are discussing investment ideas and financial planning advice that can really work for young working professionals. So, Shailesh, we've spoken about, of course, the short-term and the medium-term goals. Now let's talk about long-term. And as you said, long-term is anything that I want to do 7 years down the line, perhaps. Equity, my best friend in that case?
It's an asset class which has a lot of potential, tremendous potential, because that actually fully participates in the, the growth of the economy, the growth of the country. And, what are we buying when we are putting money into equities? The only purpose is we are investing and participating in very good businesses which will compound over a period of time. And equities as an asset class have a power to harness those returns, right? Everybody cannot be an entrepreneur, right? So somebody has to have entrepreneurs working for them. I think as an investor, maybe if you have 50 companies in a mutual fund portfolio, you end up having 50 entrepreneurs working for you effectively. So I think equities do wonders if you look at from a compounding point of view. That's an asset class which can have a compounding opportunity and actually are well suited from long-term goals point of view.
Okay. Your thoughts, Mr. Rungta, on equity as an asset class. And I think a lot of us, I'll speak for myself, we sort of get introduced very early on because as you're working, that ELSS category, Section 80C, you don't think when you're doing it, you think, oh, this is just some tax planning. But later on, as the years go by, you realize what wonderful things that small ELSS amount can really achieve.
I think very clearly, as events have proved in the past, I think people who have had experience, as long as you have patience and you have time, and one of the big things, as Shailesh says, for young people is that they have time on their sides. In fact, I would say that staying out of equity is a risk that young people cannot afford. Okay, I would reverse the equation. Very clearly, equity for young people for goals that are long term, I think is a compulsory asset class rather than option.
Okay. Now, the plethora of funds, there are so many different categories within equity mutual funds, Shailesh. Then there is a concept of actively managed funds, passive funds, exchange-traded funds. So there are lots of news headlines out there. How should a young person go about deciding what kind of an equity fund he or she needs?
I think primarily when you look at equity products, they come from 100% equity, which is there, and in large or mid-cap categories, the two specific categories which are there. I think a combination of these two with a horizon which lasts about 5 years, 10 years, or 15 years is a very good combination because large caps give you the stability as a category in terms of these are established businesses which are growing, and the mid-caps are businesses which can have the potential to become large-cap companies over a period of time. So just a reasonable combination of it based on how much volatility a person can digest, and they continue using simple SIP kind of a route, which is like a positive EMI, if I may say like that, and then that works from a period of time. I think so. Just simplifying just two categories out of these would be enough for meeting longer term goals.
Oh yeah, SIP. I think that's one acronym that's become sort of synonymous with the equity culture that we see spreading in the country as well. Your thoughts, Mr. Rungta, on this? For young people, is SIP the best way to go? Or, as and when you have some cash at hand or you've saved up, let's say, a couple of months down the line, then you go and invest. See, and then the question of, but has the market run up too much? What should I do now? So perhaps those kind of queries also come up.
So I think there are two things with the SIP. Some people think SIP is the investment itself. And SIP is a mode of making
it's a way of investing.
Right?
Yeah.
It's like doing a recurring deposit. Just like you do a fixed amount every month. So a recurring deposit in a mutual fund, you can say, is a SIP, right? And it can be any kind. It can be debt, it can be equity, although it's most used in the context of equity.
Yeah.
The advantage of a SIP, the biggest advantage of a SIP is it takes away this question, okay, has the market run up? Has the market gone down? What's going to happen to the political? I think what a SIP does is that over time, As the prices go up, you would get less units, obviously, because if you invest the same amount, as prices go down. As prices go down, you would get more units.
Absolutely.
I think as long as you understand that SIP is not a magic bullet that will take away capital losses. It could happen. It generally, in a SIP over long periods, it might, in between it might happen, but in the past, over long periods, you have always ended up having good returns. And when I say long periods, I'm talking 7, 8, 10 years. Not really shorter.
Absolutely. I think that's something that has to be understood with this asset class. That this is not sort of for overnight gains. It's not here and now. This is really serious wealth creation that we're talking about. Speaking of which, I mean, the power of compounding. Of course, a lot of experts like yourselves always talk about this concept of compounding when it comes to equity. So, Mr. Rungta, do you want to sort of give an illustration to us? What are we really talking about, when we, let's say, invest a certain period, a certain sum for a certain period in time? Returns are not guaranteed. They're not fixed. But something ballpark that helps us understand what we can create.
Just to put it in context, if a 25-year-old cuts out 2,000 rupees, which is not very difficult for most and puts it in an equity mutual fund, assume it gives him a 12% return, no guarantees, till he retires. That's 35 years. 2,000 rupees does not change, remains 2,000 rupees for 35 years. At the end of 35 years, that money will be enough to buy him a flat in Vasai. Not bad. Not bad at all.
That's an illustrative example. It could happen that way. Generally, those are the kind of numbers that time, just the sheer power of time, I think, throws up. Shailesh, any specific advice that you'd like to give out there when we're talking long-term goals? And also, I mean, when we're saying long-term, nobody wants to think retirement. Definitely not when you're so young.
Sure.
But equity, I guess, can also be the best asset class to start securing yourself for the eventual retirement, right?
See, retirement for a lot of young people, it is a very early goal to think of. But I think the earlier you plan, the easier it is. Retirement should be a goal even for a very person who's just starting to invest or just into his first job, because that effectively sets him free over a period of time in terms of, what all he wishes to do after a point of time.
Okay, fair enough. Well, very interesting thoughts and, of course, very enlightening sort of conversation as well. Just goes to show if you start planning a little early, be a little careful about where you're investing your money, it could go a long way in helping you realize your own dreams. On that note, let's actually throw this open to our very interesting, intelligent, young audience out here. Let's see if they have any comments to share or any thoughts, any questions.
My question to you is that I've heard a lot about equity-linked saving schemes. So the ads claim that I could save tax and it would create a lot of wealth over long term. So could you please throw some more light on it?
Like I said, underlying economic activity, growth, or the kind of companies and businesses which these funds invest in can have good longer-term growth potential. So you get the power of compounding because equities as an asset class do offer that. Plus you get the advantage of tax saving. So tax saving comes from there and wealth creation comes from the underlying power of compounding, which equity as an asset class can offer over a long period of time.
So I save near about 20,000 rupees a month. So if I were to invest this amount today, what would you have me do, as to how to allocate this amount across all these options that you've spoken about?
Ideally, this should go into an equity scheme. And ideally, if you need the tax breaks, and to some extent you will, to that much extent, it should definitely go into an equity-linked savings scheme. As Shailesh explained, an equity-linked savings scheme is effectively a discount given by the government to encourage you to put money into wealth-generating asset. The balance can go into a large cap. In your case, I would say put it in a large cap equity scheme. Okay.
I have a question. There are various apps through which we can invest in these funds. So my question is, can you tell me which instruments do I invest in and what's the money I can redeem instantly?
Liquid funds have the option, you can get money back pretty quickly. So it's not a challenge from that point of view. And also there are enough digital tools today and digital applications today which allow you to transact, seamlessly. So the product offers the flexibility of quick redemption, plus also gives you like you said, it is primarily for short-term requirements. So I think it serves the purpose of that as well. So short-term investment purpose along with easy access to your own capital. It's also using digital tools to redeem and to access the same money.
Well, all right. That's a good note to end on. I think it's brought in fair amount of clarity and left our audience with a lot of food for thought as well. So thanks to both of you gentlemen for being with us and sharing all these enlightening thoughts with us, and thanks to our audience as well. That's it on this special telecast. Thank you for watching.
Reliance Mutual Fund and CNBC TV 18 present Mutual Fund Day, Mission Prosperity.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Focus. Ideate. Innovate. Enable.